broader world, like why do we do what we do? We generate alpha, we create yield so that people can take their savings and live off of it really well and retire off of it really well.
And so I want to just kind of really cap on this and break this down and then take a look at some protocols that offer what I'm aiming for. All right. So again, it just gets the brain juices flowing. And then afterwards, I'll open the floor for conversation. All right, so let's transition over to the second portion of this video breakdown today. This is where I want to get into kind of like formulating a strategy after this bull market cycle to never go broke, right? So whether it's you utilize your profits after this next cycle, maybe you do sell some of your crypto assets for profit, or maybe you just in the moment, in the now, are building cash positions like I am while the market's at a premium, while the market's pumping. I'm not buying into these types of market conditions. It goes against my dollar cost average strategy. So that means I'm still entering into the market at discounted positions, but with lighter positions. And with that said, the capital that I'm not using to allocate into the space aggressively right now, I'm putting into stable coins to build stable coin positions that are earning yield, right? And this ideology has really started to pick up as of recent because of the increased stablecoin adoption via institutions. Just kind of what we've been talking about in this community to understand that we never have to sell for fiat currency, even if you are to sell. Maybe like for example, XRP goes to $1,000 in the future, and you do want to take some profit to mitigate, a pullback risk in your portfolio. You sell it $1,000 and you're under the assumption that price is going to pull back to 500 so you can get back in at a discount. If you have that mindset, then this strategy is again something that you could start to think to formulate in your own plan. Again, this isn't like the blueprint that's going to succeed. This isn't something that's going to like take us all to the next level. It's just an ideology and it's a possibility. And so I'm going to go over some of the protocols that I'm looking at, the strategy, the mindset that I have around this stablecoin portfolio that I want to build of $500,000. And it really all kicked into gear for me when I heard this lady, Christine Moy, say that their goal is to build a future environment where people can retire off of their savings. Okay. And that is huge because that's not really the environment in which we live in today, right? So if you have, $500,000 in a savings account in your Wells Fargo standard savings account, like you're not going to get um, you know, the same amount of yield in return that you're going to get if you had that money parked in DeFi versus traditional finance. And so maybe there are some traditional financial exposure tools that allow you to incorporate that yield structure into your portfolio, but definitely not to the point where you can fully control it via the palm of your hand with an internet connection and a mobile device. Okay. So the landscape is shifting, and it would encourage I would encourage you guys to start to think about these things. Like, what are you going to actually do with the profits if you do pull profit? Hopefully, not spend the profits, right? Learn how to lend those profits out, borrow against them, keep your initial principal, and then use the borrowed capital to pay back some of your loan by earning yield on it, while also buying yourself something nice or spending it on whatever it is you need to spend it on. But just again, this notion that we don't have to get out of crypto, we don't have to get out of Web3, right? So I just want you guys to listen to Christine Moy real fast. I'm always trying to give you guys opinions and perspectives built off of what the institutions are saying. I don't really wake up in the morning and I wasn't just like, oh, I'm going to tell everybody that I want to build a $500,000 stablecoin portfolio just because I want views and likes. No, I'm like doing that because I'm a real market participant in the space. And I would love to do what she says in this like 30-second clip that I'm going to show you guys, where she says, hey, like we're building a digital wallet infrastructure future through DeFi tools and primitives to where people with enough yield, because these DeFi solutions offer double-digit yields, you can retire off of your savings, right? And that's something that I feel like a lot of people this next cycle aren't going to do because they're just not in the right mindset. They're not in the right headspace to become their own bank. Not in this community. We're not going to let this opportunity pass us by. And so I'm just going to continue to show you guys these tools and these primitives that are going to allow for this to happen. So take a second here and listen. I'm done my rant, but listen to what Christine Moore here says.
There's actually conflation of bank accounts and investment accounts, whereas, in regular world, we kind of keep them separate. And so, and I think that if there was anything that we've learned about smart contracts and DeFi is that smart contracts are incredible rebalancing like different types of assets. It's just that to date, it has been like different types of crypto assets, which, are all part of your existing diversified portfolios. But in the future, and talking about expanding access, talking about like, let's say the depositors of Tether, like in the future, you can have like an expertly designed, diversified portfolio composed of, stables, treasuries, AAA, CLOs, private credit, equities, designed by an expert financial advisor. Could be like your classic, like Morgan Stanley, UBS, could be, your next generation vault curator. And essentially, regardless of if you have millions of dollars, thousands of dollars, hundreds of dollars, or tens of dollars, you will still be able to have like perfect, like a really well designed, yielding and fully invested portfolio just for you. Just at a click of like your crypto wallet. I think that's like really incredible. Like, when we think about how do we, I mean, at Apollo, like our main mission, I know this sounds really cheesy, is like to help people save better, to help people retire better. I know all of you young crypto people are like literally like, what are we retiring for? Maybe early retirement.
They're all retired.
Yeah, you invest in like your Apollo product. But like, basically, like in the broader world, like why do we do what we do? We generate alpha, we create yield so that people can take their savings and live off of it really well and retire off of it really well.
Right. So retire off of your savings. And so when I heard that, I immediately think of a number that I personally would need to retire off of my savings. Now, I'm going to be completely honest with you guys. With all the business endeavors that I have going on, which is about 7 sources of income, I already have and make enough money to retire. Like if I wanted to hang up my hat right now, delete all my social media platforms, lock you guys into CYPRX and say, look, everybody that's in CYPRX and Scalpers program is grandfathered in and we're not accepting anymore. All my traditional passive income and what I might make off YouTube is enough to retire me. Pay that means pay my monthly bills and then some to live comfortably. But that's not where I want to stop at. And so I would like to have that in traditional finance, my trading income, but then also just a crypto stablecoin portfolio that if all of those other things failed for me, I could just go to my crypto savings portfolio, like she said, your savings portfolio, your savings, and retire off of that. So that number for me when she said that was $500,000, right? 10% at a minimum of $500,000 per year, which I feel like 10% in this new DeFi ecosystem on $500,000 annually is very doable. But you could probably get a lot more. And that's what I'm going to kind of go over today. So my goal after her saying that you could retire off of your savings was $500,000. $500,000 in a savings account that I don't touch, that's just in stable coins, that's just there to retire me in case all else fails, right? So that's kind of where this ideology and this mindset came from. I don't know, a couple weeks ago or months ago when I expressed that I was going to start doing this and building towards this portfolio. And so I want to just kind of really cap on this and break this down and then take a look at some protocols that offer what I'm aiming for. All right. So again, it just gets the brain juices flowing. And then afterwards, I'll open the floor for conversation. Maybe you guys can tell me what you plan on doing after the next cycle. Maybe if you align with what I'm saying, then we can again start bouncing ideas off of each other. But this is just an open space call after I go through this to kind of make sure that we all survive 2030 and beyond, right? Because becoming our new banks is going to require this thought process. Like I said, this strategy may or may not work. We're going to have to adjust things. We're going to have to move to changing times, regulations. APYs are going to adjust if they're not locked in, if they're not, what's the word I'm looking for? If they're not fixed APYs, we're going to have to adjust a lot of things. And so this is just the start of that, right? So here is a backdrop that I typed out using ChatGPT by just giving it a couple of different parameters that I'm expecting in this portfolio that I would like to build. So lending platform. So I would like to have these stable coins diversified in two different types of protocols. That's lending platforms and DEXs being a liquidity provider in stablecoin pools. That's my goal. Now, Christine Moy also mentioned money market funds, and she mentioned a whole bunch of other different investments. I might expand this $500,000 portfolio allocation to money market funds, but it really just depends on if money market funds reflect the current interest rate or if there's another type of DeFi premium that they can offer for higher yield. But that'll all just depend on how the future unfolds. So for now, I'm looking to do this on lending platforms and liquidity pools on DEXs. All right. So my goal is to spread $300,000 evenly across three different lending platforms to diversify my risk, $100,000 on each, yielding an annual target of at least 9% minimum. That's my goal. Now, like I mentioned, that 9% or above could fluctuate. So there might be weeks or days, depending on liquidity conditions, where that 9% threshold could not be met. And again, that will require active management on my behalf, where I'll have to come up with something where it's like, okay, it's been 2 weeks and the APY of this one lending platform that I'm on hasn't gone back above 9% and it's just lingering at 4%. When there's an opportunity over here on this platform to make 11%, well, that's again why I want to stay in Web3 and not traditional finance, because I can easily get out of that position, transition all the stablecoins to my wallet, and then put it into another protocol just like that, right? Um, so the projected annual yield, if I am to achieve $300,000 spread out across three different platforms with a 9% minimum on each platform, is $27,000 a year. And the monthly return on that, again, this is minimum, would be around 2,250 bucks per month. Now, the platforms that I'm going to show you guys, most of them offer above 9%, but 9% on these lending platforms is my minimum. So that means my strategy in the future is, if I'm in these positions, like I said, I'll write down a time parameter for myself. So like no more than 2 weeks below 9%. And if it's below 9% for more than 2 weeks, I'll consider adjusting and moving to a different platform, right? So tips I wrote here. I would like to see strong audits on these platforms, transparent reserves, an ideal on-chain lending platform like Aave, MetalX Lending, Flare Loans, any type of these like sustainable platforms that have a healthy TVL. And then obviously, of course, I talked about variable versus fixed rates. That's very important. Okay. If we can find platforms that have fixed rates, they're going to be a lot safer for forecasting these percentages that we're going to get annually. So our goal would be preferably to put these into fixed positions, so that way we know we're going to get 12% for 3 months or 4 months, exit the position, lock in another position for another quarter, 3 months to 4 months, whatever. That way we can actually track the yield better, and it's not variable, it's not fluctuating. Where I said here, variable yield can give upside during liquidity squeezes, but then also, can shoot to the downside. Like just the other day, somebody on the MetalX lending platform put a $1 million into the USDC pool, and that dropped the yield down to 4%. It's back above 4% now. So again, my parameter, if MetalX lending, right, wasn't offering me on my USDC position more than 9% for longer than 2 weeks, I would consider changing it out to a different protocol, right? So again, I'm just trying to get the brain juices flowing on some strategies around repositioning and rebalancing and stuff. Um, Opportunities to loop assets if risk appetite allows. Post digital assets as collateral, borrow stablecoins, redeposit, repeat. You have that ability with these lending platforms as well, especially during different types of market cycles, which I'll focus on here in just a second. For my liquidity position, so I would like $300,000 spread out across three different lending platforms. Like I said, for my liquidity pools, I would like to take $200,000 and put it into two different liquidity pools, $100,000 in each, earning a annual yield target rate of at least 12% minimum. So two stablecoin positions, stablecoin to stablecoin, on two different liquidity pools to diversify risk. And again, if I can meet that 12% minimum threshold, just going off of minimums here, with $200,000, that would be about $24,000 per year, or about $2,000 per month. So in total, I'd be looking at anywhere between $4,000 to $5,000 per month, depending on fluctuations. On the medium end, on the high end, $5,000 plus. And on the low end, if these price fluctuations flip to the downside and I'm not meeting these minimum percentage thresholds, I'd be looking at anywhere between $2,000 to probably $3,000 a month in passive income. right? So again, the goal is just to have a stablecoin portfolio that I can retire off of. Now, for me, I need about five to $6,000 a month to retire, right? So that meets my retirement thresholds. Okay. Tips here. Focus on pairs with deep liquidity, steady volume, low and permanent loss risk. So that means only being in stablecoin pools, not stablecoin volatile asset pools. If you're pairing this with lending platforms, we need to choose pools that support our collateral strategy, i.e., providing liquidity in assets that we're also going to be able to borrow against. However, that's not really important because now it gives you the ability on the borrow side to pick different assets. But just in case, I thought I'd throw that in there. In case the lending platform that you're on doesn't offer that, then you need to make sure that you're in a stable coin that you'd like to borrow against if the lending platform doesn't let you set what asset you want to borrow in. So here's just an overview and a screen graph of that portfolio allocation. And I said here, in a bear market or a pullback environment, what I can do if I choose to do so, why I want to have 300,000 in lending platforms, is I can borrow against my lend out assets to buy dips, or I can put that capital that I borrow against my lent out $300,000 into liquidity pools to boost my liquidity pool yield, and I can use that yield to buy the dips. So just threw that in there as a little thought process of just infinite money glitch, right? Some just key considerations to end this are rebalancing. So, like I mentioned, yields will fluctuate. So, I need to consider reviewing allocations, whether that be weekly, monthly, or quarterly, just to keep sure that my targets are on track. Diversification, which we covered, spread out my assets across different platforms and also different networks. And then liquidation protection. If I am going to use looping strategies, then I need to monitor my collateral ratios and keep very healthy buffers. You never want to put yourself in a pinch or a position where you're stressing about your DeFi positions because you're close to a liquidation threshold. This is not trading. This is not leverage investing. There's no need to put yourself in a mental position like that or a mental strain. So make sure that you're giving yourself buffers. Make sure that if you are borrowing against your capital, that you're putting enough of that borrowed capital into something else that's earning you yield so that you can use that yield to pay back your loan and mitigate your liquidation risk in times of volatility. Okay? So that's just kind of the presentation and my mindset of my strategy. Now let me just go into some of the platforms that I found, how I found them, just so that way you guys can go in as well. And I just did this as easily as possible. So that way it's kind of like beginner level. Anybody can go do this themselves, find these platforms. So remember, for my lending platform, my ideal target was 9% minimum. I prefer double digits, but I'll take high single digits of 9%. I think honestly, if I were to give myself a downside buffer, the lowest that I would go is 7% yield. No lower than 7%, preferably 9 and above. For my liquidity pools, 12% minimum. Because they're liquidity pools, if it drops below 12% for more than 2 weeks, I'm cutting that one dry. It's out and on to the next one. There's no buffer to the downside. 12% or above, that's stamped. Preferably something above 12%, right? So if you come over to DeFi Llama, they've changed things around slightly. So in order to look at lending platforms indexes, you would simply just go to the metrics tab right here. And then you scroll right over here and click on categories. Once you're on categories, you can see you have different categories. So remember, we want to look at lending platforms and DEXs, preferably DEXs that have liquidity pool features. That's at least for my strategy, right? According to what I just wrote out. So you could click on the lending tab, you click on the lending tab, and boom, it gives you a whole entire list of all the lending protocols in DeFi. Go through, click them, look at different yield opportunities that they offer, go through, look at the team, look at the TVL, check the platforms out, do your due diligence on them. Don't just go and jump on them, right? So doing that, looking at a couple of the lending platforms that I found, first and foremost, Drift Institutional. Drift Institutional, we know, is backed by some of the largest organizations in the game, Apollo Asset Management and Securitize. Hint, hint, Drift Institutional was my first pick, built out on Solana, considering that Christine Moy was the one who threw this ideology in my head that, hey, you should be able to retire off of savings. And right here on lent out USDC, they are offering that 9% minimum of 9.52%. There's a healthy TVL on this with about $309 million in deposits. Not too bad, not too shabby, right? So I'm just showing you guys a platform that I found where this, allows me to facilitate if I chose to deploy on this platform to meet my requirements. The next platform, MetalX. MetalX made it back on the list as the APY on this jumped back up. So again, the ideology behind these variable APYs, it's not going to be the same every day. So you are going to need to build a strategy out behind how many days you're willing to sit below a certain APY threshold before you make a decision to move that position. So for me, it's probably going to be 2 weeks because this is a long-term portfolio on like an annual basis. 2 weeks of yield below my threshold isn't going to really impact my overall profit margins, right? So if the APY can pop back up after 2 weeks above my APY threshold, I'll stay in the position. If it doesn't, I'll consider moving it out, right? So loan markets, MetalX lending, loan protocol, right now they're offering 16% APY. So remember I said that if the variable margins go above my minimum thresholds, then my annual salary from my savings portfolio is going to substantially increase. So this is good to see. Okay. Over here on Maple Finance is backed by a whole bunch of different institutions. They're involved with a whole bunch of different institutions, and they have a substantial amount of TVL. And they're one of the most trusted yielding platforms in the game. And one of their high yield secure lending over collateralized loan platforms right here allows 10%. So that meets my threshold. Again, just showing you guys another platform. Euler, coming over here, I found interesting, and this is something else to note, is not just diversifying in the form of the protocol, not just diversifying in the form of the chain that you're using, but also diversifying in the form of the asset, the underlying asset, so the stable coin itself. So I plan to be diversified between USDC, USDT, and maybe even some RLUSD if these opportunities can continue to persist as I build this portfolio. So here is Euler Finance. This is another lending platform. And right now they're offering 13% on RLUSD with a $99 million TVL. So very substantial and healthy position here. And then even under that, Gauntlet down here, because this is offered by Centaura, Gauntlet down here is also offering a higher ended single digit yield for RLUSD. So you can see this is definitely a little bit on the low end spectrum, but they still offer 8.32% on lent out USD. Coming over here, it's a BenQ. They have a supply side USDC for 10.44%. Not too entirely sure what this AUSD is, but if it floated your boat, they also offer a double digit yield of 10% there and a high single digit USDT yield of 8.6%. So this platform meets the threshold and the requirements for the minimum of 9% on lending. Morpho. Morpho was a little bit on the low end, but still high single digits. 7.2% for Smokehouse USDC with a healthy TVL of 218 million. So all of these platforms met my TVL requirements as well, just for the records. Venus was another one. However, the only thing about Venus that I found is that it, in order to get the double digit yields, requires a booster, and I'm not too familiar with all of that lingo yet. So, albeit this platform does meet my requirements, which is why I'm throwing it in the mix, I'm not too familiar and probably wouldn't use to or choose to use this platform until I became familiar with that. But you can see here on USDT to supply, you originally get 5.14%. and they give you a booster of 8.6%, which puts that, excuse me, at about what, 12%, 13% yield. Down here on USDC, they're giving you about 10% yield with the booster. And in both of these positions, there's a healthy TVO. And last but not least, for all the lending platforms that I found that met my threshold, my requirement, which is a high single digit, preferably above 9%, Fluid was definitely on the lower end, which was my last pick, with their USDT position here at about 7%. Right? So those are all the lending platforms that I found. Going back over to DeFi Llama, going back to the homepage, back to the metrics tab, categories tab, and then now looking at DEXs. So just going in and looking at some liquidity pools, what I would do is if you're in search for this type of strategy is go in, look at the different assets. So since we're just looking at stable coins, you can type in the search bar, the chain that you want, and then just look for stable coin pairs. Mitigate all the noise that you're going to see on this platform by utilizing the little tiny toggle tabs to toggle different features. But here's all your dexes. So you could go into all these dexes, go to their stablecoin pools, and look at what they're offering. The three that I found, one that I'm primarily using right now is the Tap Exchange. I've been in this pool now for I think going on 4 months, and the APRs never drop below 15%. So this is definitely one of the ones that I'm headstrong about. Tap Exchange offering the USDT USDC pool right now after refreshing at 27%. You could see before I refreshed it, it was sitting at a 20%. They also offer triple asset pools. So you have a triple asset stablecoin pool here, USD1, USDT, and USDC offering 29%. I've never participated in this one, but I just noticed it now. So interesting, right? But this definitely meets our minimum threshold of 12% for liquidity pools. Aerodrome is another trustworthy platform that's been in the game for some time, has some skin, and has a substantial amount of audits, TVLs, and just historical context in DeFi, considering DeFi is relatively speaking not that old, but Aerodrome survived some of the largest liquidity crashes, price fluctuations, and has made a name in the game for themselves. And their team's transparent, who's on their team, who their developers are, all that stuff is there. We've already done the research on that. So just another platform that, if you can find good liquidity pool options, would be a platform to possibly consider for diversification means. Right here, they got a USDT, USDC pool with 16 million, 18%. They got a Euro USDC pool with 44 million, 36%. You guys catch the drift. There's good size pools on here that are offering above the minimum threshold of 12%, right? They got a MSUSD and USDC pool sitting at a $2 million TVL with 22%. So there's a couple of different options here for you to diversify into and choose. But again, just another DEX to consider. This was my second to last DEX. This was Balancer. Now, I'm not too familiar with these stable coins, but when I typed in stable coins on DeFi Llama and I typed in liquidity pools, Balancer popped up. I've never heard of Balancer, but still these pools meet our requirements. So I would just need to just do some due diligence on the pools and the stable coins. But you can see here US DAI, USDTO offering 12.5%. You also down here have a SUSDE and a USDTO on, I believe this is what isn't this, what is this, Primal? What is this chain? Does anybody know what this chain is? I'm having a brain fart right now. Kev,
Sonic.
is it Sonic?
It looks like Sonic. I can't. My screen.
Hold on, let me go back. I'll show you right now what
It
chain
looks
it
like
is.
Sonic.
Da-da-da-da-da. Yeah, anyways, it's a chain, honestly, that I'm not too familiar with, but I did notice that. So again, I just need to do some research. But anyways, here I'm just trying to show you guys, right? So you got a stable coin pool, and it's offering double-digit yield of 13%. Last but not least is Pendle Finance. Pendle Finance, if we come over here, one thing I liked about this platform and why I wanted to throw it in at the end is it does mention fixed APYs instead of variable APYs. So again, this would be one of those things that we would have to learn, have to try to incorporate. But I mentioned if you can get fixed APYs for the strategy and you can lock in, I mean, here it says stablecoin US DI, 48% fixed APY for 44 days. You know, if you can secure those types of positions, why not? Because then you can verify profits almost in a sense, right? So I just wanted to throw this protocol in there, and you can see down here they got a USDE on Athena with a fixed variable rate at 9%. So that's on the high end. Same thing, USDE on Athena, 9% on the high end. Don't know what this is, US DI, which is I'm assuming a stable coin, and that's sitting at a fixed rate of 48%. So, and these TVLs are all healthy. Like this isn't like some random low balling platform. Like there's $217 million right now sitting in this 48% fixed APY. So, you know, that's why I wanted to show it to you guys. There's some other ones here. You got USDO at 9.8%. You got an 11% here on a stable coin. So again, just like this goes on. This platform looks really juicy. I'm not gonna lie. CUSD, 15%. So a lot of different variable options, but in fixed terms. So you got fixed APYs. I definitely have to figure out how to utilize a platform like this, as I never have personally, but just something to consider, right, for your strategy and diversification tools. Okay. Oh, here it is right here. Let's see. What is this? What platform is this? Let's see. Protocol, or excuse me, what chain this is. No, it's not showing me. All right, whatever. All right, so yeah,
It
that's
said
all.
plasma.
Plasma, thank you. Yeah, geez Louise, plasma. That's what did I say? Spectre? What did I say? I said something weird.
I forget.
Plasma.
Yeah, if you hover over it, it says the name.
Hold on, let's see. Oh yeah, plasma. There it goes. Yeah, so it's plasma. It's the plasma network. All right, moving on. All right, so to finish this, to wrap it all up and open the floor to you guys, right? So the goal is to not ever have to spend my own money in the future. So I said, like, yeah, let's build a retirement strategy with $500,000. But my goal is that anything that I want to spend on myself in the future, so if I can make $5,000 a month, I don't even remember the last time outside of this last CYPRX link up when I dropped 13 grand on the mansion that I've spent that much money. Like I usually don't spend money. So if I can make 5 grand a month, that means for the rest of my life, relatively speaking, if I live below my means, which I plan on doing, I'm not a materialistic person, 5 grand a month can literally buy me anything that I want for forever. So, with that being said, with this strategy, guess what you can do with it? You can have a crypto debit card. You can literally just funnel all of your yield to your crypto debit card, which now a crypto debit card like Phantom Cash that they're about to release coming soon. If you guys haven't applied for this, I suggest you do. Is you're also going to be able to earn additional yield by holding cash. It's this new Phantom stablecoin. It's called Cash in your crypto card and earn yield on it. So it's like this notion behind earning every single dollar that you have up until the very last moment that you spend it. So if I go out for the day to spend money, I'll pull some yield from my stablecoin position, send it over to my cash position, and even though it's not going to end or earn me a bunch of yield for that day, up until the very last moment that I spend it in my cash wallet, I'll be earning, which is just so mind blowing to me. It's like this never ending feedback loop of just yield, on chain principle, constant buy pressure, just this whole, again, notion behind being able to retire off of DeFi and really just mitigating the risk and the volatility that crypto exposure gives you by diversifying into stablecoins and having a stablecoin portfolio, right? Not always just being on this back end spectrum of, oh, I need price appreciation to become rich or financially free. No, you can do that off of stablecoins. You don't even need price appreciation. If you could just get a solid, in my opinion, $500,000 in a stablecoin diversified portfolio, you're freaking Gucci, literally, honestly, for the rest of your life, in my opinion. As long as you don't have like a $10,000 a month living expense bill and you want to like drive out and skirt out in Lamborghinis every single day, which for some of you that might be your goal. Lamborghinis for me are personally uncomfortable, so that's not my lifestyle. But yeah, you know, $5,000 a month on on the high end or medium end, and then $3,000 a month on the low end off of 500,000, 100% achievable. So Again, I'm not diversifying on any of these platforms yet, except the one that I showed you, which is Tap, and I'm on Metal right now. So these are the only two platforms out of this entire strategy that I'm currently utilizing. Um, I do plan to continue to do more due diligence on these platforms before I deploy, but I just wanted to give you guys insights to show you that according to my strategy and the parameters that I set for myself in terms of the APYs, they do exist. All right. So that's my spiel. I'll leave the floor open. Hopefully, you guys enjoyed that short, just quick presentation and just the mentality that I have going into this new whatever future we're headed into. And this is just one of the many doors that I'm going to be creating for myself over the next consecutive couple of years to just never have to work, right? To never have to do anything for money and just use the market to reciprocate funds and rehypothecate and do all these things that we want to do with. So go ahead. I'll leave the floor open for questions. I'll stop my rant.
Bro, oh my God. This is some crazy, crazy stuff. Like I'm looking at some of these asset managers, right? And the stable coins that they're offering and the yield that's going to be a part of it too. I'm thinking about the other RWAs that they're going to be tokenizing on their platforms as
Yeah.
well. Like this is so many businesses that are being
Mhm.
created off obviously of what we earn and put into these kind of platforms and earn yield off of them, especially like fractional real estate ownership,
Mhm.
digital art,
Yep.
NFTs.